Satyajit has a new book. It's called Extreme Money, and now it's been dubbed The Social History of High Finance. It gives an insider's view of high stakes of financial risk-taking in what he now sees as a financialized global economy. It's all about making a brazen push for profit, and he says that's exactly what's led to the risks we're seeing today. From Sydney, Australia, I spoke to him via Skype.
I think it looks at, the last 30 or 40 years, because we've been through an extraordinary period of financialization. Money went from being something very simple, which was a means for exchange and a store of value, to something which drove modern economies. People don't seem to realize that if you look at the United States, roughly 50% of its growth in the last 10 years or so was driven purely by debt. And that is the central thesis, is that's unsustainable, and effectively we're coming to an end of a period of growth driven by the steroid. And so we're now going to have to adjust. And it's taken us 30 or 40 years to get here. Anybody thinks we're going to get out of it in 12 months is delusional.
I mean, if I was to simplify the text, I'd say we come from an era of the Industrial Revolution where industry started to drive economies, to then moving into a situation, as you're saying, of the financialization of the global economy where money became an industry in itself. And as we know, industries come and go. So is this the end of financialization as we see it?
Well, I think it's the end of financialization to the extent that we've seen. For instance, I think you're absolutely right. Economies tended to be driven by things like productivity improvement, innovation, population growth, and new markets. But what happened in the 1970s was growth slowed, so we had to find these new sort of accelerants, which we chose debt and speculation, which is what I term extreme money. And basically, what that now shows is that's just a dead end. Now, what we'll have to see is a rebalancing of the economy in terms of more real engineering as distinct from financial engineering. And that process is going to be very painful. That doesn't mean financial institutions will cease to exist. They will still exist, but they'll go back to the future. They'll be more into matching borrowers and savers. It'll be basically trying to actually provide simple risk management tools and provide safe payment mechanisms. The days of high finance as we've seen it is probably coming to an end. Unfortunately, nobody stole the bankers, and they're still clinging on. The masters of the universe don't die easily, and they're clinging to old notions. And what we're seeing now is this tremendous attempt to cling to the past. There's a wonderful line in F. Scott Fitzgerald's The Great Gatsby. You can't repeat the past? Why not? And we're trying to do that. And I think ultimately it'll prove to be unsuccessful.
I mean, there is the famous saying in business that you've got to spend money to make money, and clearly that's where some of the risk elements have come to the fore. As new economies rise, as we start to see people moving into energy infrastructure, ICT, we're still going to need money as a basic commodity to transact. We're still going to expose money to certain elements of risk in new industries. How can we mitigate against that?
No, that's absolutely correct. But that's money being put into real products, real goods, real services, real innovation. What we found was had money chasing itself. We lived in an era of what I call candy floss money. As you know, candy floss is a tiny bit of sugar superheated. We increased the velocity of money in the economy, and that came to drive essentially asset prices. If you look at the gain in asset prices, whether it's in equities, whether it's in property, even in commodities, over the last 10 or 15 years, a lot of that's been driven by the flood of money chasing those assets. So you're absolutely correct. We're going to go back to proper risk-taking, which is more industrial in nature. The other thing which is actually very important in that process is that we actually start to price risk properly. The flood of money actually had a very distorting effect. Risk actually came to be mispriced. And we've got to go back to proper pricing of risk. But in the meantime, you were talking about emerging markets. In emerging markets, the efforts of the developed economies in trying to actually, I suppose, apply almost a Band-Aid to a gunshot wound, they're actually causing enormous problems. The printing of money, for instance, is leading in the, the developed countries to some advantages, but in the emerging countries, it's creating problems of inflation. And if you look at countries like China and India and Brazil, who have large amounts of foreign exchange reserves, the value of those reserves, which are in dollars, in yen, and in euro, are being dissipated at a frantic rate. So extreme money in that sense has very destructive as well as positive effects.
To use your metaphor of putting a Band-Aid on a gunshot wound, let's go to the measures currently being taken to try to stabilize financial systems. We're seeing the European Central Bank being urged to mop up the bonds in Italy, to come up with a stabilization fund for Greece. We may see a downgrade of France because of the exposure of their banks. We're seeing a new round of quantitative easing possibly in the United States. These economies have to work for the rest of the emerging market economies to thrive. They ultimately create the core market that Africa and Asia is looking for. What do you make of those stabilization measures?
Well, I think the first thing is the fundamental premise of that is that nobody has actually admitted that there's too much debt. In fact, all we're seeing, particularly Europe's a very good example, the answer to debt seems to be to reshuffle the debt around in some shape or form. And the European Financial Stability Fund, the European Union, the IMF are all measures, essentially, of trying to replace one lender with another. By the way, I'm in serious trouble with the ECB and the European Union. When they tried to leverage the European Financial Stability Fund, I wrote a piece for the Financial Times where the first line was, this proposal doesn't need economic assessment, it needs psychiatric assessment. And they weren't very pleased. But I think fundamentally, they haven't got the message. That's the first thing. The second thing, you're absolutely correct. Because of the globalized nature of industry and exports and imports, one of the problems is we've been through this theory of decoupling, where the emerging markets somehow mysteriously are going to decouple, and they're going to go their own way. That's not going to happen, because as you correctly point out, the developed economies are still the export drivers for the demand for these emerging economies. But the problem is the actual slowdown in the developing economies has forced, for instance, China to almost go to an extreme money, if you like. China's pumping in 30 to 40% of its total GDP in new loans to create growth because they're terrified of the social consequences of actually having high unemployment, not being able to absorb new workers into the workplace. And that ultimately is going to set off an emerging market crisis potentially. So these games that are being played to try to solve the problems in the developed economies are not really going to be successful. Ultimately, we know how this game ends. You can only get out of a problem of debt by high growth and high inflation. And we're not going to get high growth. We're not going to get high inflation. So under those circumstances, there's going to be a Japan-like period of slowly grinding out the debt out of the system, which is going to be extremely painful. And unfortunately, emerging markets like South Africa will not be immune from the effects of that.